I'm going to say this the way I'd say it inside a meeting when time is expensive. If you want to build wealth, stop looking for comfort in consensus. Consensus is where returns get diluted. The crowd doesn't create advantage, it prices it away. When everyone agrees something is safe or obvious, it's usually already expensive, already over-owned, already optimized by capital that moves faster than you do. Following that is not investing. It's volunteering to be average. The environment doesn't need to be calm for you to act. Calm is not a requirement for good decisions. In fact, calm is often the worst time to find asymmetric opportunity because competition is highest. The best opportunities usually appear when the signal is buried under noise, when headlines are screaming, when people are emotional, when they're forced to sell, when certainty collapses. That's when pricing detaches from fundamentals, and that gap is where disciplined capital should go. Most people interpret fear as a stop sign. That's a mistake. Fear is data. Fear reveals where weak hands are, where leverage is fragile, where sentiment is doing the work that analysis should be doing. In engineering terms, stress testing is how you discover what's real. You don't learn anything about a structure when there's no load on it. You learn when it's under pressure. Markets work the same way. Volatility is the load. And under load, weak systems crack over-leveraged companies, fragile business models, leadership teams that were only effective in easy conditions. That collapse is not random. It's selection. This is why the whole interesting environment thing matters. When inflation worries rise, when interest rates change, when recession talk spreads, most people become reactive. They chase safety hoard cash, sell quality to feel relief. They treat uncertainty as a reason to do nothing. But uncertainty is the price of admission. If there were no uncertainty, there would be no mispricing. If you want returns beyond the baseline, you have to operate where emotion creates distortions. But here's the key: you don't strike because you're brave. You strike because you're prepared. Preparation is not watching more content. Preparation is building a decision framework. It's knowing what you're looking for before the panic starts. Because once the market becomes chaotic, if you don't already have principles, you'll become the chaos. You'll buy what's rising, sell what's falling, and call it risk management. That's not risk management. That's surrender. A real investor has a model, not a complicated model, just a correct one. Something like this. Does the company produce real cash flow, not promised cash flow? Does it have pricing power, or is it a commodity that gets crushed when costs rise? Does it have a strong balance sheet, or does it survive only when money is cheap? Does it have a moat, something structural that makes competition hard? Does the leadership allocate capital intelligently, or do they chase optics? If you can't answer those questions, you're not investing. You're guessing. And the reason I don't follow the crowd is the same reason I don't build products by committee. Committees don't optimize for truth. They optimize for social safety. Real progress comes from first principles. Find what's true, then act on it, even if it's unpopular. In markets, that means buying quality when people are irrationally pessimistic, not when they're euphoric. It means being comfortable looking wrong for a while if your fundamentals are correct. When you see everyone paralyzed by fear, what you're actually seeing is a system-wide failure of discipline. People don't lose money because they lack information. They lose money because they can't control their own behavior under stress. They sell because they want relief, not because fundamentals changed. They buy because they want excitement, not because value improved. So if you want an edge, stop thinking like a consumer of financial content. Start thinking like a builder of systems. Define your criteria. Decide your time horizon. Understand your tolerance for volatility. Then when the market offers mispricing, when good assets are forced down by bad psychology, you're not surprised. You're ready. Fear is not your enemy. Undisciplined behavior is. Investing starts with a simple but brutal filter. Does this thing actually produce real output? Not promises, not projections, not slides, output. If a company cannot generate consistent cash from real customers solving real problems, everything else is noise. Growth stories collapse under stress. Hype evaporates when capital tightens. But cash flow doesn't lie. It's physics. Either energy is being converted into usable work, or it isn't. That's why fundamentals matter more than narratives, especially in unstable environments. When conditions are easy, weak systems can survive. Cheap money hides inefficiency. Low rates forgive bad discipline. But when pressure increases, only systems with real margins, real pricing power, and real balance sheets remain standing. Stress doesn't create failure. It reveals it. Pricing power is non-negotiable. If a company cannot raise prices without losing customers, it is structurally fragile. Inflation exposes this immediately. Costs rise whether management likes it or not. Labor, materials, energy all move. A company with pricing power passes that through. A company without it absorbs the damage until margins collapse. That's not bad luck. That's bad design. Balance sheets are the same story. Debt amplifies outcomes. In good times, it looks smart. In bad times, it becomes lethal. Companies that only survive when money is cheap are not resilient systems. They're interest rate trades pretending to be businesses. When capital tightens, they don't adapt, they beg, dilute, or fail. Then there's management. Most people underestimate how much damage poor capital allocation does over time. You can have a good product and still destroy shareholder value by chasing expansion for optics, overpaying for acquisitions, or prioritizing short-term stock price over long-term durability. Discipline shows up in boring places, controlled spending, conservative leverage reinvestment, where returns are provable. This is why I ignore excitement. Excitement is usually a signal that expectations are already too high. When expectations are high, the margin for error disappears. And in complex systems, error is guaranteed. What you want are businesses where expectations are low, fundamentals are strong, and survival does not depend on perfect execution. Investing isn't about predicting the future in detail. It's about owning systems that don't need perfect futures to work. When markets become volatile, the question isn't what will happen next. The question is which systems are built to function no matter what happens. That's where capital belongs. Energy infrastructure is one of those systems that exposes how little sentiment actually matters. Energy has to move. That's non-negotiable. Economies don't run on opinions or headlines. They run on electrons, molecules, and logistics. Whether markets are euphoric or terrified, energy still has to flow from where it's produced to where it's used. When you own the infrastructure that enables that flow, you're not betting on prices. You're collecting tolls. From a first principles perspective, this is powerful. You remove speculation from the equation. You're not guessing where oil prices go next month or what politicians say next quarter. You're owning the pipes, the storage, the terminals, the physical systems that everything else depends on. Volume matters, not noise. and volume is remarkably stable over long time horizons. What makes these systems durable is friction. Regulatory friction, capital friction, time friction. You cannot replicate large-scale energy infrastructure quickly. Permits take years, construction takes years, capital requirements are massive. That creates a structural moat. Competition isn't eliminated by clever marketing, it's eliminated by physics and regulation. Predictability is the key output here. Long-term contracts, locked-in throughput agreements, cash flows that can be modeled years ahead. That predictability allows disciplined capital allocation, paying returns, maintaining assets, investing incrementally without risking collapse. In unstable environments, predictability is leverage. There's also a misconception that energy infrastructure is obsolete because of renewables. That's shallow thinking. Transitions don't eliminate demand, they reroute it. Intermittent energy sources increase the need for backup storage and balancing systems. Gas infrastructure doesn't disappear in that world, it becomes more critical. Systems that stabilize volatility gain value when volatility increases. The important point is this infrastructure doesn't need to be exciting to be essential. In fact, the less exciting it is, the more likely it is to be mispriced. Attention flows toward narratives. Capital that compounds flows toward necessity. When everyone is distracted by what's new, durable systems quietly keep working. That's where long-term returns come from. Not from guessing the future, but from owning what the future cannot function without. Healthcare is driven by something far more reliable than cycles or sentiment biology. People age, systems wear down, entropy increases. That's not a trend, it's a law. You don't need to forecast it. You don't need to debate it. As populations age, demand for medical care rises automatically. That demand doesn't pause for recessions, rate hikes, or market corrections. It persists because it's tied to survival, not discretion. From a systems perspective, this creates one of the most resilient demand curves in the economy. People may delay buying cars, upgrading homes, or traveling during downturns, but they do not delay necessary medical treatment. When something is essential, price sensitivity drops. Reliability matters more than marginal cost. That's where durable pricing power comes from. The strongest healthcare businesses are not the ones chasing breakthroughs for headlines. They're the ones embedded deep in the operating layer of the system, supplying tools, devices, consumables, and services that hospitals and providers cannot function without. When a product becomes part of standard procedure, it stops being optional. Switching costs rise. Relationships harden. Trust accumulates over decades. Scale amplifies this effect. Large healthcare platforms gain efficiency advantages smaller competitors can't replicate. They negotiate better input costs, spread fixed expenses across larger volumes, and reinvest more consistently in incremental improvement. That compounding efficiency shows up as stable margins and reliable cash generation even when the broader economy weakens. Diversification inside the business matters too. Multiple product lines, multiple end markets, multiple revenue streams. If one segment slows, others compensate. This internal balance reduces volatility and allows long-term planning. Stability at the system level is what enables disciplined capital return. Consistent reinvestment, steady payouts, and controlled growth without excess leverage. Valuation still matters. Paying any price for quality is not rational. But paying a fair price for a system with durable demand structural moats and proven execution is often better than chasing cheapness in fragile models. Quality compounds. Weakness doesn't. Healthcare works not because it's exciting, but because it's unavoidable. Systems tied to inevitability don't need perfect conditions to perform. They just need time. Real portfolios are not built on excitement. They're built on systems that survive stress. When you combine infrastructure that moves energy with healthcare systems that support aging populations, you're not making a bet. You're anchoring capital to inevitability. These are sectors that don't require perfect execution, perfect timing, or perfect macro conditions. They function because the world cannot operate without them. This is the mistake most people make. They start with speculation and hope stability appears later. That's backwards. Stability is the foundation. Cash-generating, boring, durable systems create the base that lets everything else work. Without that base, every downturn becomes existential. With it, volatility becomes opportunity. Markets will crash again. Rates will change. Headlines will scream. None of that matters if you own businesses that continue producing output through the noise. When prices fall, dividends still arrive. When sentiment collapses, fundamentals remain. That's how patience becomes a competitive advantage. The goal isn't to predict the next trend. The goal is to own systems that will still matter in 10 and 20 years. Energy must move. People will age. Those facts don't depend on opinions. They don't care about cycles. They just persist. If you build your portfolio around persistence, you don't need to panic. You don't need to react. You don't need to guess. You let time and compounding do the work. That's what real investing looks like. Quiet, durable, relentless. Design your portfolio the way you'd design a machine, remove fragility, prioritize function, and let it run. That's how wealth is built, one disciplined system at a time.